I'm Mira.
So, right now there are roughly 400 commercial ships physically trapped in one of the most critical energy transit choke points on the planet. And today, that geopolitical standoff violently collided with the global financial markets.
Yeah, it really did.
I mean, if you were just glancing at the major U.S. equity indices on Monday, May 4th, 2026, you might have, been lulled into a false sense of security. The S&P 500 slipped, but only modestly to around 7,200.75.
Right, but beneath the surface of that, the real headline was an absolute explosion in the commodities market. Brent crude skyrocketed, the 10-year Treasury yield spiked near 4.45%, and gold just completely collapsed as a surging U.S. dollar took over.
Exactly. Which is exactly why we're going to give you the complete roadmap of how we got here today. We're unpacking the weekend collapse of peace talks, the intense military clashes in the Strait of Hormuz today, and why a key Fed official is stepping in to calm everyone down.
It is a lot to cover.
It is. But before we jump in, a quick reminder that this deep dive is for market context and discussion only, not personal investment advice or a recommendation.
Right. Definitely need to keep that in mind.
So let's get into session one. What set the stage before the U.S. session?
Well, to understand the velocity of today's moves, you really have to rewind to Friday, May 1st. The geopolitical backdrop deteriorated so rapidly heading into the weekend.
Right, because President Trump officially rejected that 14-point Iranian peace proposal.
Exactly. That proposal was transmitted through Pakistani intermediaries, and the market had essentially priced in a high probability of a diplomatic off-ramp.
But the administration just completely pulled the rug out from under those hopes, so any pricing of a quick ceasefire evaporated.
Yeah, and Iran's response over the weekend wasn't just rhetorical. They formalized new transit tolls in the Strait and explicitly banned all Israeli vessels from passing through.
Wow.
Yeah, they're attempting to codify this blockade into a permanent maritime regime.
And that brings us to the U.S. countermove. Because of the 400 trapped commercial ships, the U.S. announced Project Freedom. It's this military-led operation to forcibly unblock the strait, and it was scheduled to begin Monday morning Middle East time.
Which is like pointing two heavily armed militaries at the exact same narrow strip of water. And, global markets didn't wait for the U.S. to wake up.
Yeah.
As Asian and European markets opened Monday, the inflationary fear of this energy shock just took hold instantly.
Oh, absolutely. We saw the Bank of Korea's Deputy Governor Ryu signal a very hawkish shift. He noted it's time to consider rate hikes because they are so reliant on imported energy.
And Europe was in the exact same boat. ECB officials Peter Casimir and Joachim Meigel were warning of prolonged price increases early on Monday.
Right.
Casimir actually went as far as stating a June rate hike is, quote, all but inevitable.
Okay, but we really have to challenge the logic of that European reaction mirror. Like we've talked about before, monetary policy cannot fix supply shocks.
That's true.
Hiking interest rates in Frankfurt is not going to magically clear commercial ships through the Strait of Hormuz. It just crushes demand without creating a single drop of new oil supply.
Yeah, they know it's a blunt instrument, but they're terrified of losing credibility on price stability. But that dynamic set a really tense tone for the morning. You had failed peace talks, military operations teed up, and central banks threatening to hike rates straight into a supply shock.
Talk about a fraught setup. So that primed the pump for a highly volatile U.S. Open. We're going to take a very short break right here to let that sink in. And stay tuned for how the U.S. trading hours actually unfolded.
We'll be right back.
All right, we are back. Moving into session two. What moved markets during U.S. trading hours?
Well, Daniel, the defining catalyst was the actual execution of Project Freedom. It kicked off Monday morning, and it was immediately chaotic.
It's just a mess.
Yeah, by mid-morning Eastern time, reports were flooding in. A UAE ADNOC vessel was hit by drones, warning shots were fired at U.S. warships, and the UAE Defense Ministry intercepted multiple ballistic missiles from Iran.
Plus that massive fire at the Fujairah petroleum site.
Exactly. And the market reaction in commodities was just massive. Brent crude surged 5.8% to $114.44. WTI jumped 4.4% to 106.42.
And the U.S. dollar index, the DXY, rose to 98.54, which absolutely crushed gold, sending it plummeting to a low of 4,510.10.
Right, because of that huge flight to safety into the dollar instead of gold.
Exactly. But, when you see this reflex to view geopolitical events just as unpredictable natural disasters, I think we have to look at it through a different lens.
How so?
Think about geopolitical brinkmanship as game theory leverage. Both sides are utilizing the strait to maximize their negotiating power. They're forcing the market to price in extreme tail risks intentionally.
That's a great point. But regardless of the intent, the market still has to price in the physical constraint. And adding fuel to the fire, U.S. factory orders hit at 10 a.m. Eastern time, rising a very hot 1.5%.
Right. And with the economy running hot, people start panicking about inflation.
Right.
Because we know energy shocks act as a lagged consumer tax.
Yeah, it slowly suffocates consumer spending. But then at 12:50 p.m. Eastern Time, New York Fed President John Williams stepped in with some serious dovish reassurance.
It was a huge moment.
It was. He stated he doesn't see a case for rate hikes right now. He noted long-term inflation expectations are steady, which proves that central bank independence anchors inflation expectations.
Yes, and he cited AI as fueling a massive productivity surge that could absorb some of these costs.
Exactly. But the bond market wasn't entirely convinced. At 3 p.m. Eastern Time, the US Treasury announced an $860 billion borrowing plan for the next 2 quarters.
Right, $860 billion. That is a massive supply of new debt. And the 30-year yield reacted instantly, hitting 5.025%.
Which is huge.
It is, because discount rates act as gravity on valuations. When yields break 5%, it exerts this immense downward pull on equities, which is why the market couldn't hold on to its early resilience.
Yeah, you just had intense cross-currents all day. Soaring oil, spiking yields, and Fed reassurances all pulling in different directions.
It was exhausting to watch. So that wraps up the macro drivers. We'll take a short break here, and then we'll dive into specific corporate impacts.
Sounds good.
Welcome back. Let's pivot to session 3, corporate events recap and what to watch next.
Well, we have to start with energy. Chevron's CEO came out and warned that global oil storage buffers are being drawn down rapidly and supply is tightening.
Which is not surprising given the 400 ships stuck in the strait.
Right. So the energy sector, the XLE, was a rare bright spot today, rising to close at 59.39, but it was a different story for European autos.
Yeah, the US and EU trade tensions from the weekend carried right over. The French and German finance ministers reaffirmed their stance against Trump's threatened 25% tariffs.
And the market did not like that dual threat of high energy costs and tariffs. The Stoxx Europe Automobiles Index dropped 1.6%. BMW and Mercedes-Benz both fell over 1%.
Ouch. But then you look at mega-cap tech, and it's a totally different world. The US and EU advanced talks on vetting AI models today.
Right. Alphabet discussed accelerating clearance for Google TPUs, and the EU contacted Anthropic.
But despite all that regulatory chatter, tech remained a defensive safe haven. The Nasdaq fell only a modest 0.19%.
Yeah, investors clearly view AI CapEx as a self-reinforcing arms race. They're going to spend the money no matter what.
Exactly. Well, folks, between the missiles flying in the Strait of Hormuz and Brent, crude rocketing past $114 a barrel, the only thing advancing faster than energy stocks today is the Treasury's $860 billion borrowing plan.
Sad but true.
I mean, if you were heavily invested in anything other than crude oil, your portfolio probably feels like it just took a warning shot from the Iranian Navy. But look on the bright side. At least Fed President Williams says he doesn't see a case for rate hikes right now.
That's the silver lining.
So grab a drink, try not to look at the 10-year Treasury yield, and let's hope tomorrow brings a temporary ceasefire to our brokerage accounts, just like the one in Ukraine.
Nice one, Daniel. But seriously, looking ahead to tomorrow, Tuesday, May 5th, there are some critical catalysts to watch. At 8:30 a.m. Eastern Time, we get the U.S. trade balance for March.
Which is going to be super important to see the physical trade flow impacts.
Yeah. Then at 10 a.m. Eastern Time, we get the ISM Services PMI and JOLTS job openings.
Right. We need to see if the consumer and the labor market are starting to crack at all.
Exactly. And finally, at 11 a.m. Eastern Time, we get the Treasury buyback announcement, which everyone will be watching after today's massive borrowing plan.
For sure.
Yeah.
So as we wrap up this deep dive, Mira, what's the final takeaway?
You know, as we watch tech stay completely resilient while energy costs explode, the real question is whether this AI productivity boom can actually act as a strong enough counterweight to a sustained $115 a barrel oil shock. Are we watching a real-time battle between the physical economy being constrained and the virtual economy being decoupled?
That is the big question.
Yeah.
Let us know which side of that battle you think wins out in the comments below.